The market looks incredibly resilient right now, but under the surface, there are actually some cracks forming in the foundation of the bull market. I'm talking specifically about a measure called market dispersion, which is the degree to which the best performing stocks in the market are beating the lowest performers. Now, we've seen this play out in 2017, and I'm sure you've heard by now of this FANG group, which is Facebook, Amazon, Netflix, Google, and then when you combine it with Apple, that's about 10% of the S&P 500. And those companies have not been shy about throwing their weight around the market this year. They've made a series of new highs, and we've seen that reflected in the S&P 500. But what that's done is it's masked weakness in parts of the market that may go a little unrecognized. Dr. John Hussman, the president of the Hussman Investment Trust, has some thoughts on the matter. He closely watches dispersion and says that when it reaches an extreme or increases a very large amount in a short amount of time, that could imply that investors are getting a little more nervous and maybe starting to get a little more risk averse with their behavior. And if you think about it, that's really what we've seen in stocks. They've really chased after the best performers. We've seen the same tech stocks being pushed up to new highs repeatedly. And then we've seen that on the downside as well, the same companies being ignored. Hussman has some thoughts. Across history, this sort of shift in investor preferences, coupled with extreme overvalued, overbought, overbullish conditions, has been the hallmark of major peaks and subsequent market collapses. This chart has Hussman particularly worried. The rapidly dropping red line represents the percentage of US stocks above their 200-day moving average. Not only has this fallen significantly, it's also now near 50%, which would represent a perfectly bifurcated market. Now, to provide some historical context, Citigroup has put together a handy chart that shows you what high dispersion has meant for stock market returns throughout history. It shows an index of US stocks versus a measure of how many stocks are making 52-week highs. And as you can see, when just a small number of stocks are setting new highs, that's historically matched up with stock market bottoms. So what are we trying to say? After all, Wall Street strategists are still incredibly bullish on the S&P 500 heading into year end. And we've also seen earnings growth chugging along at a pretty steady clip. What we're trying to say is when the bull market progresses, just keep an eye on the whole thing. Don't just look at the winners. Don't just pile into the winners. Take a look at what's on the downside, the companies that are maybe bringing up the rear a little bit. If you start to see patterns form, the same companies increasing, the same companies decreasing, that could indicate dispersion, which is something that could inspire market worry.